Hi traders, welcome back. My name is Matthew from the Art of Trading. Today's lesson is going to be covering how to use arrays in Pine Script. We're not going to do anything too complicated. We're just going to introduce you to the basics, but we are going to create something pretty useful. We're going to create a correlation meter, which is going to determine exactly how correlated two different markets are. And we're going to achieve that using arrays. So if that sounds like something you'd be interested in, please stick around, hit the like button while the intro rolls, and we'll get started in a second. So the script we're going to be working with today does a couple of different things. The first thing it does is it stores the past X amount of price data. So in this case, we're going to use candle closes by default, but you can change that here. But we're going to save the last 20 candle closes on the current market and on our reference market. We're going to save those values into two separate arrays, and then we are going to use some inbuilt Pine Script functions to analyze that data. We're going to get the correlation between these two data sets, and we're also going to get the covariance. Well, we need to get the covariance first, and then we use the covariance to calculate our correlation coefficient. Now, if all of that sounds like gibberish to you, don't worry. I literally learned most of this stuff this morning. It's not rocket science, but it is quite advanced for a fool like me. I have the equivalent of math dyslexia. So if I can handle this, you should be able to too. And as we go through the lesson, I'm going to explain all of these concepts, hopefully in a way that makes sense to you, whether you are experienced with this stuff or a complete beginner. So with all that said, let's get started. So right now I have Euro-Yen weekly chart up on my TradingView charts. The script is drawing these red lines here. These red bars are the S&P 500 closes. So if it closes positive, that means the S&P 500 closed higher. And if it closes negative, that means it closed lower. And by closes, I mean percentage gains. So each bar on this indicator box here represents the percentage change from the previous bar on the S&P 500, but we can change this to whatever we want. So we could change this to Aussie Yen, for example, and now we're comparing the Euro Yen's weekly candles to the Aussie Yen's weekly candles, and as you can see here, we have quite a high correlation. The closer this black number is to 1.0, the more positively correlated these markets are, which just means that if one market's moving up, then the other market is also likely to be moving up. And the micro movements might not be the same, but the correlation number here, the correlation coefficient, can give you a rough idea of just how correlated a market is. And what this would be useful for, there's a few uses you could use this for. In Forex trading, the way I would use this is I would use it to determine which currency pairs are likely to be correlated so that I can manage my risk accordingly. So for example, if I'm trading the Euro Yen and I'm long on the Euro Yen, let's say I have a high probability setup and I'm aggressive with it, I have 2 or 3% of my total capital involved in that trade. It's probably not a good idea for me to then open a trade on Aussie Yen with the same amount of risk if these two pairs are highly correlated, because all that means is that if one trade loses, the other trade is likely to lose as well. And then I'm taking a double hit for nothing. What would be better in that scenario, if I do have two trading opportunities on two highly correlated pairs, would be to split my risk. So if I have one position on Euro Yen, that might be 1.5% risk, and on Aussie Yen, I might have 1.5% risk as well. That way, in the unlikely or off chance that one of them wins and one loses, I don't double my loss by taking a large position on a correlated market. And there are other use cases for this as well, which we'll go into later. But anyway, let's get into the code and I'll explain what we're doing as we go. And if you're already lost, don't worry. This should make sense by the end. Hopefully this makes sense by the end of the lesson. I'm going to do my best to explain all of this stuff in detail. So let's get into the Pine editor and start this lesson. And just really quickly, before we get into the Pine editor, I thought I should probably show you a visual representation of what an array is. It's basically just a list of data. So here we have our values, and they can be anything. So we saw that here. They can be a float, an integer, a boolean, a color, a string, and they're stored in these little boxes which correspond to a array index. So similar to historical operators for price action, like referencing previous bars, you can do the same thing with arrays. Now, dealing with them in Pine Script is slightly different to using the historical operator, which, if you're not sure what that is, that's the square brackets to reference previous bars. So you could reference the previous closing price like this. You could also reference the value corresponding with the array index of 1. It's the same concept in theory. And arrays in Pine Script have a maximum size of 100,000 data values, which is quite large. I don't think there's many cases where you would need to exceed that many data entries into an array. So that's what an array is in Pine Script. Just think of it as a data set with each entry corresponding to a array index, which starts at 0 and counts up from there in increments of 1. And so in this particular case, we have 9 values, an array length of 9, but the array index for the final entry in this array is 8 because we do start at 0. So keep that in mind. That takes a little bit of practice to get used to if you're not used to dealing with arrays. Anyway, let's jump over to the Pine editor and get into this script. First thing I'm going to do is delete all of this code, and we're going to start from scratch so that you can follow along and see what I'm doing, and I'll explain what I'm doing line by line. All right, so first things first, we just have a blank script here. We just have our study annotation function. You can call this title whatever you want. I've set overlay to false because I want to be drawing into my own oscillator box or indicator box. And the first thing I'm going to do here, as always, is get some user input. I'm just going to copy this code over here because hopefully by now, if you've followed enough of my lessons, you should know how getting user input works. We're getting 3 user inputs here. We're getting a look back period, our price source, and our reference market. So we're using the inbuilt input function, just titling them accordingly so the user knows what they correspond to. And I'm setting the types. Our look back is going to be an integer. This is how many bars to look back. Our source is a price source, which can be anything. If I minimize this and open this up, here is our price sources. And you can also choose from price sources on indicators or markets that you've added to your chart. So if we wanted to, we could calculate all of this data based on an average of the open, the high, the low, and the close, or just the high, the low, and the close. For today's lesson, I'm keeping it simple. I'm sticking with close. And then the final input we're getting is our reference market. That's just a type of input.string. And this default value here, if you've never used the security function to reference other markets other than the one that you've loaded onto your chart, the format of this is you can either just put in the string. I could have just put in SPX 500 USD here, and that would reference that market, that ticker ID. This is the ticker ID. But I like to also specify which brokerage or exchange I want to get that data from. So in this particular case, we're referencing the Oanda exchange. I'm using the semicolon to then reference the ticker ID. So this is the broker or exchange. This is the market I want to reference. And this works with any exchange. If you go up into here and we type in Apple, for example, you could write NASDAQ Apple. So I could change that to NASDAQ and Apple if I wanted to. And then this would reference Apple's price from the NASDAQ exchange. So that's it for our user inputs. So the first thing we need to do before we continue is get the percentage change of our reference data. So the way we do that, I'm going to create a variable here that references the security function. And the security function takes a minimum of 3 parameters or arguments. We need to specify the symbol we want to reference. We need to specify the resolution or time frame we want to reference. And we need to give it an expression that we want to reference. So this could be anything. This could be an indicator expression. This could be any number of code expressions that you could use in Pine Script. But for today's lesson, we're going to be keeping it really simple, and we're just going to be referencing the source input. So by default, this is going to be the closing price. So our symbol is going to be our reference input, and our resolution is going to be our time frame dot period. So that's whatever time frame we've currently set our chart to. So right now I'm on the weekly chart. This would just reference the weekly chart on our reference market. So hopefully that makes sense. So now just to make sure that we're getting the right data here, let's plot our reference data to the chart, save the script, make sure there's no compile errors. And there we go. Everything's working fine. If I go to SPX 500 US dollar, this blue line should mimic the closing price of this chart. I'll get rid of that, don't need that. So it's on percentage right now. 3935 and 3935. Perfect. So far so good. And get rid of that plot. So the next thing we need to do is get the percentage change of the current bar on our reference market compared to the previous bar. So to do that, I'm going to create a new variable called reference change. That is going to be set to, I'm going to open two parentheses here. I'm going to say reference data subtracted from our previous bar's reference data divided by our previous reference close multiplied by 100. This line of code here, this expression, will give us our reference market's change as a percentage. So now if I plot this to the chart, reference change, save the script. Oops, and I have a typo here. Hopefully that's the only one. There we go. Minimize that. So now this blue line here is printing the percentage change. So up here you can see that the current bar has a plus 0.84% change from the previous bar, and down here we have 0.8 or positive 0.8. So we are calculating an accurate reading. So that's how we get the percentage change in price. Next thing we need to do is get the percentage change of our current market. So to do that, I'm going to create a new variable called current data, and this is going to be set to our source input. So we want to compare the same source across our reference market and our current market. So if you were to change this default value to something like OHLC4 or open high low close, then it will compare the average of our open high low close on our reference market to the average of our open high low close on the current market. And again, to get our percentage, we can pretty much copy this line of code here. I'm going to change this to current change, copy current data, we can paste that across there. And now we're getting the exact same percentage change calculation, but on the current market instead of our reference market. So now we have our two value data sets. All that's left to do is input these into an array. And then once we have some data to work with, we can start calculating our correlation coefficient. So now we have our two data sets. We're getting our reference markets change and our current markets change. All that's left to do is input this data into two different arrays, and then we can use those arrays to perform some statistical calculations. So to declare an array, it's extremely simple. I'm just going to comment this here. We're going to use the VAR operator. And if you're unfamiliar with the VAR operator, all that does is it makes sure that this variable we're about to declare does not get reset on each new bar. It's only declared once on the very first bar on our chart, as opposed to these variables here, which are not VAR variables, and these get recalculated on every new bar on our chart. But since we're using arrays, the whole purpose of arrays is to store data across all of the bars on our chart so that we can perform calculations and analyze that data. So if we don't create these as VAR arrays, then these arrays will be cleared and reset on every new bar on our chart. We don't want that. So we use the VAR operator to make sure that doesn't happen. And we're going to create two arrays here. One's going to be called reference array, and the other one I'm going to call current array. So reference array is an array or a list of our reference markets change in percentages, and current array is exactly the same, but for the current market that we've loaded onto our chart. And let me change this market so that we have two different data sets here to work with. So to declare an array, you need to use the array inbuilt array object or class, and this array operator just contains the list of all the inbuilt array functions that we can work with in Pine Script. So arrays behave very similarly in Pine Script to lines and labels. So if we were creating a label here, you would write label.new or line.new. But for today, we're using arrays. The main difference with arrays is that there is a number of different data types that we can reference. So you can make a color array, you can make a float array or decimal point number array, you can make an integer array or whole number array, you can make a label array, a line array or a string array. Today we're only going to be working with floats. So floats are just any number with a decimal place, such as a price or a percentage value. So the array.newFloat function, if we click on this this function name, we can get a rundown on exactly how this function works. This function can take either a single input parameter or function parameter or two function parameters. So one is the size of the array. If you're unfamiliar with arrays, think of them like lists, with the main difference being that we need to specify the length of the list before we start working with it. And initial value is the initial value of all array elements. So think of this as like a default value for your arrays. We're not going to be using the default value today. We're just going to be using the array size. And for our array size, we're going to reference our lookback input parameter. So if I paste lookback in there, by default, these two arrays will be initialized as floating point arrays with a lookback period of 20 or a size of 20, meaning that these two arrays will hold 20 historical price changes as percentages. By default, if you don't change this variable here in your script settings, then these two arrays will be initialized with a length of 20. And so these arrays will store the past 20 bar changes as percentages. So because we have an array length of 20 here, our lookback is set to 20 by default. So our array length is only 20 data values. We need to make sure that every time we add a new value to our array, we delete a previous value to make room for it. So the way we're going to approach this today in this script is we are going to use a first in, first out approach. If you're not sure what that means, there's a little diagram here that's quite helpful. So we're creating a queue version of an array. You could also create a stack version. Today's version is going to be a queue. So the first value that goes in gets shifted down until we hit our array size. In this case, it will be 20. So when we have 20 values in our array, the first value that entered this array will be the first one to be deleted. And so we basically cycle through with a first in, first out approach. An alternative method for using arrays is a last in, first out approach, which is like a stack. So think of it like a stack of papers. You stack up a bunch of values for whatever reason, and there are some cases where you don't want to remove the very first value. You want to remove the last value that went in first. But for today's lesson, we are just focusing on a queue array. So the first variable that goes into our array is the first one to be deleted when the array's maximum capacity is reached. So in order to achieve that, we need to shift or remove the last or the first entered value from our arrays, which is a first in, first out approach, or FIFO for short. And to do that, we need to use the array.shift function, and then we need to input our array ID. So ID stands for our array variable name. So if I paste that in there, that will delete the very first data value we entered into our reference array before we add a new variable into this array. So this will make sense in 1 second, because the next thing we're going to do is add the current values to our arrays. In order to add a value to an array, we need to use the push function. So the array.push function, you can think of this as an array.add function. This will add our data value to the specified array. So the array we're going to add to first is our reference array, and the data value we're going to add to this array is our reference change. So our percentage change for the current bar. And by current bar, I mean the current bar that this script is running on. So this happens to be a historical bar, then that bar's percentage change will be added to the array. And once our array hits our maximum capacity of 20, it will start deleting or removing the first value that was added, like a queue. And we'll cycle through those values as more data is printed to our chart. So I can copy this line of code here, and we can push to our current array our current change as a percentage. So these 4 lines of code here handle all of our array operations. We are first removing the oldest data value from our array before we add any new data values to our array. Give me a second. My cat wants to come in. Look at it. Here he is. He doesn't like being locked out of the office. You want to help me? Or are you going to be annoying? Huh? This is Hunter. Hunter S. Thompson, if anyone's wondering what his name is. You go and entertain yourself for a bit. So now that we've set up our array commands or functions, the next thing we need to do is determine and plot our covariance relationship. So covariance, I found a pretty good definition here on Investopedia. So first, what is covariance? Covariance measures the directional relationship between the returns on two assets. A positive covariance means that asset returns move together, while a negative covariance means they move inversely or apart. Covariance is calculated by analyzing at-return surprises or standard deviations from the expected return, or by multiplying the correlation between the two variables by the standard deviation of each variable. Now, some of you will understand what all of that means. I don't. But the good news is we don't need to understand this in order to use it in our script. So let's go back to the Pine editor and determine our covariance. Best of all, we don't even need to write the code ourselves. I'm going to create a new variable here called covariance, and that's going to be set to array.covariance. So this inbuilt function will perform all of that calculation for us in a single line of code. Couldn't be easier, which is perfect for dummies like me that have no idea how to calculate this stuff. So to get the covariance, we need to reference two arrays so that we can get the variance between the two of them. So we're going to input our reference array here and our current array. And we're done. We're getting the covariance. But before we continue, we should probably plot that data to the chart so that we can visually see what's going on. So I'm going to plot our covariance value. I'm going to give it a color of color.purple. I'm going to give it a style of plot.style_area. I'm going to give it a transparency of 0, and I'm going to title it our covariance. So now I'm going to save my script and make sure everything compiles, and there we go, working perfectly. So as you can see, throughout this period here, which was the peak of the COVID pandemic outbreak. So if we have a quick look, if we look at the 16th of March on gold, and we go over to the S&P 500, and we look at the 16th of March from there, you can see that since that day, both these markets have moved higher. So during this period, we had a positive covariance or a directional correlation. So these markets were moving in sync, but that's not always the case. There are occasions when we have a negative covariance, and that means that these markets are moving in opposite directions. So anyway, our script is working as we want it to. So let's finish writing our code, and then we'll go and look over a few different covariance and correlation examples over various markets. So before we calculate the correlation coefficient between these two data sets, let's plot our reference market data to the chart just for visual representation. So here I'm going to say plot our reference data. I'm going to use two plot functions here. One is going to plot our reference change. The other is going to plot our current market's change, and then we're going to set the color of our reference market to red, our style to plot.style columns. We're going to set transparency to 10, and I'm going to give this a title of reference market. And then for our current market's price change, we're going to set the color to blue. We're going to set the style to plot.style histogram. We're going to set the line width to 4. And then I'm going to title this one our current market. So now if I save the script, we should get a little bit of a different visual representation on the chart. So the red bars here is our reference market's percentage change. So each bar on our chart, this red bar is representing our reference market, the S&P 500. Its percentage change on that same bar. And the blue number here is the percentage change of the current bar. So you can see here we had a 0.73% change on the current bar. That corresponds to the same number up here. So far so good. Let's wrap up this script by calculating our correlation coefficient. Before I do that, I should probably explain what that is. So here we are back on Investopedia. I'll leave these links in the video description. And here's a short summary definition of correlation coefficient. The correlation coefficient is a statistical measure of the strength of the relationship between the relative movements of two variables or two markets. The coefficient values range between -1 and +1. If they fall outside that range, then there's been an error in the calculation. So a correlation of -1 shows a perfect negative correlation, meaning that for every dollar a market goes up, the other market goes down $1. And a correlation coefficient of +1 shows a perfect positive correlation, meaning that for every dollar a market goes up, the reference market also goes up $1. And finally, a correlation of 0 means there is no correlation, no direct correlation between the two markets or two variable data sets. So ideally in your portfolio, depending how you've set it up, you would hedge your positions by trading a market with a negative correlation to whatever market you're investing in. And from a trading perspective, if you are creating a trading strategy across a portfolio of different markets, ideally you'd want a correlation as close to 0 as possible. Because if you have a high correlation between two markets that you're trading, it's the equivalent of doubling your risk. Now obviously you can double your reward that way as well, but it's just magnifying your trading results. If you can find two markets that have 0 correlation or as close to 0 as possible, that's a good deal as far as portfolio theory goes. Or in other words, the closer to 0 your correlation coefficient is across all the markets you trade and invest in, the more diversified your portfolio is. And so for investors, your portfolio might be a bunch of stocks. You want those stocks to have as little correlation as possible. And for a trader, you want your strategies and the markets you trade to have as little correlation as possible, at least in a perfect world. With currencies, that can be a little bit difficult, which we'll show at the end of the lesson where we finish our script. I will show you the correlation between several different markets. So before we calculate our correlation coefficient between these two arrays or these two different markets, we need to get a little bit more information. First thing we need to do is determine the standard deviation of our two arrays or two data sets. Again, just like this inbuilt function here, Pine Script has made this extremely easy for us. We don't need to even know what a standard deviation is. It probably helps to know, but we don't need to because we can just use the array.stdev function, which will get that value for us. So for our reference market, I'm going to create a new variable called reference dev, short for deviation, and we're going to pass our reference array into this standard deviation function. And this line of code will get our standard deviation for our reference market. Copy this line of code, change this to current deviation, and paste that in there, change this to current array. Now we're getting the standard deviation of our reference market and our current market's data set. Now that we have that information, we can calculate our correlation coefficient, which is extremely easy. There's no inbuilt function for this as far as I know for Pine Script, but it's easy enough to calculate. All we need to do is divide our covariance by our reference deviation multiplied by our current deviation. That's it. This formula here will give us our correlation ranging between -1 and +1. So to prove that is the case, let's plot this to the chart. We're going to plot our correlation value to the chart. It's going to have a color of color.black, a line width of 2, and a style of plot dot. I'm going to use a step line for this, just for something different. You could plot this as anything you want, but I'm trying to keep this varied here and show you multiple different ways to plot this data to your chart while we're at it. And then finally, I'm going to title this our correlation strength. So this is the strength of the correlation between the two markets. Oscillating, so it's a form of an oscillator, I suppose, between -1 and +1. So that's it, our script is complete. If I save the script, hopefully it compiles without any errors. There we go. And now our black line here is plotting the correlation coefficient of these two markets. So this number here, this black number, is our correlation coefficient between the S&P 500 and gold on the weekly chart. And this value is being calculated over the past 20 bars on our chart. Pretty cool, pretty easy. So that's the power of Pine Script. The concepts that we're working with here may be very advanced. This mathematical concept may be quite advanced, but to achieve it in Pine Script couldn't be simpler. So one last thing before we continue, this was something I did that I thought was interesting. I'm gonna just paste this in here. I'm just creating 3 horizontal lines here, H lines, at +1, -1, and 0. If I save the script here, I minimize the editor, and let's just look at this visually. Basically, the purple area here is our covariance. There's not a lot we can do with this information in particular, but we needed to get that information in order to calculate our correlation coefficient. Now, this correlation coefficient is much more useful than the covariance because we can use this as a gauge to determine just how correlated 2 different markets are. And I'm going to show you exactly what I mean right now. I'm going to come up to the settings menu of our correlation meter, go to style. I'm going to turn off covariance and our reference market and current market. So now this black line represents the correlation between whichever markets we've set up here. So just to confirm that this is indeed working, right now we're on the chart for gold. Let's change our ticker to silver, and let's just see how correlated gold is to silver. So now you can see this black line hovers very close to 1, which means these 2 markets, gold and silver, are extremely correlated. It stays above 0 almost indefinitely. If we zoom out our chart all the way to the beginning of price action, this market has maintained extremely high correlation, directional correlation to silver. In layman's terms, that just means when gold goes up, silver goes up. When gold goes down, silver goes down. When gold goes sideways, silver goes sideways. In practical terms, that means that if you're putting a lot of risk on gold, you do not want to put a lot of risk on silver in the same direction, because then you're doubling your risk essentially. And for just a couple more examples, let's check the correlation between silver and the S&P 500. Click OK. We'll go to the weekly chart. I feel like the weekly chart shows the best representation. So again, after that initial panic sell, silver has rallied quite aggressively to the upside. So did the US stock market. And so we had a high correlation coefficient between those 2 markets. Let's do something a little bit different. Let's try a stock. So here is Apple compared to the S&P 500. Again, during the panic, everything sold off, and then we had this strong rally. During this period, we had a high correlation coefficient between Apple and the S&P 500. So hopefully now you're seeing how this could be quite useful in your trading process to identify just exactly how correlated certain markets are. Let's look at one last example before I wrap this video up. Let's go to a currency pair like the euro dollar. And right now you can see that the correlation between the US dollar and the S&P 500 is all over the place. There is no direct correlation here. We hover around 0 most of the time. But if we were to change our market to, let's say, euro yen, now we have a high positive correlation. You can see that this black line stays above 0 most of the time. That indicates a high positive correlation. Let's change this to Australian dollar against the Swiss franc. Now we have a high negative correlation. So this black line stays below 0 most of the time. That means that often when euro dollar is selling off, Aussie Swiss is rallying. So there's an interesting correlation statistic there that you would probably not recognize if it wasn't for this sort of information being plotted onto your chart. So that brings me to the end of today's lesson. I hope you found that interesting. This was the most practical example I could think of to use ARRAYS for. There are obviously many different ways you can use ARRAYS. You could use them to calculate support and resistance zones potentially. You could use it to store information. So for example, you could use it to store pivots or tests of support and resistance. and you can check if a certain zone gets tested more than 3 times. Maybe you can draw a H line across your chart. If current price action is within an X amount of percentage of that zone, that's a good example of a way you could use arrays. But there are many different use cases for these. Most of them are quite obscure, and so I don't think I'll be going into arrays much more on YouTube. If you want to learn a lot more about arrays and go into more detail about them, check out pinescriptmastery.com. I have a course there, the Pinescript Mastery course, where I'll be going into more detail about this if and when students request that over the months to come as I become more familiar with arrays myself. Well, that's it for today's lesson. Thanks for sticking around to the end. I appreciate it. If you found it valuable, please hit the like button, hit the subscribe button if you haven't already. I'll be back soon with more lessons on PineScript. And yeah, that's it for today. Good luck with your trading. Stay away from exposing yourself too much on correlated markets, and I will see you in the next one. Take care. Goodbye.